years, and over that time we've delivered a total NAV return of around 183%. So really strong performance. We've paid a stable, sustainable dividend for the last 15 years. That dividend is currently a 7 pence per share dividend target, and that's on a share price of around 78 pence where we are today. So that's around a 9% dividend yield on share price.
Hello, you're watching Proactive. Joining me in the studio today is Phil Kent. He's CEO at Gravis and lead manager of GCP Infrastructure Investments. Phil, very good to see you in the studio.
Thank you for having me.
So Phil, for investors new to GCP Infra, how would you describe the trust's core purpose and what role can it play in a portfolio?
Sure, so GCP Infrastructure invests in UK-based infrastructure, where that infrastructure has some form of public sector-backed cash flow. So really the universe of investments we're looking at any point is determined by those sectors the UK government is looking to support. In doing that, we focus on debt rather than equity. So in terms of a portfolio composition, it offers a stable, sustainable income underpinned by core infrastructure projects with long-term cash flows underpinned by public sector revenues.
So, I mean, you said the trust is designed to deliver regular long-term dividends. How do you balance income generation with capital preservation in today's market?
So being predominantly a debt strategy, we are very focused on downside protection. So as part of an investment process, we'll do a lot of analysis around protecting capital and how fundamentally we get paid back from an investment. All of the debt is amortising over the life of investments, so it gets paid back out of the cash flows generated by an infrastructure asset. And those cash flows in turn are supported by public sector-backed income for GCP infrastructure. In terms of income, we're always looking to ensure that the return on the debt portfolio is commensurate with the risk we're taking, but capital preservation and income are two fundamental characteristics of what we're trying to provide to investors.
What types of projects are you focused on at the moment?
So historically, the trust has invested across a range of different asset classes, and I think diversification is a real competitive strength of GCP. The fact that historically we've been able to move into new asset classes in response to the evolving landscape of infrastructure investments has been, I think, a real competitive strength. In terms of the portfolio composition, about 57% of the portfolio is in renewables, and within renewables we have quite a diverse exposure to solar, wind, biomass, geothermal, anaerobic digestion, hydro. We have some PFI PPP assets which make up around a quarter of the portfolio, and the remainder is supported social housing, so the provision of social housing to individuals with a care requirement. In terms of what we're looking at now, the UK government has embarked on a pretty ambitious infrastructure programme focused on some of the challenges that we face, so decarbonisation as an objective, but also increasingly security of supply for energy. Our changing demographics will require a huge amount of infrastructure investments to deal with an ageing population, a growing population, and the various social infrastructure needs that come with that. And also digitalisation is an area that's received a huge amount of infrastructure investments in terms of data centres and the networks and the concrete of how we deliver the internet. So there's quite a bit going on in terms of infrastructure investment at the moment, and it's really pleasing that the government are looking to support that through new schemes that offer long-dated inflation-linked revenue support.
Phil, can you take us through your screening process? How do you assess project risk, counterparties and cash flow resilience before you start committing capital? So
we have a very established risk framework within Gravis where we look at market-based risks. So really, if we take a step back, what we're looking at in an infrastructure project is an asset, and fundamentally our investment appraisal is looking to assess the cash flows generated by that asset over its life. Typically there's no residual value at the end of that asset life, so our investment proposition is that cash flow over its life. So to assess that cash flow, we look at market risk, the extent to which those cash flows could be impacted by market movements, whether that's, say, electricity prices or inflation. Credit risks, infrastructure projects are delivered by a network of suppliers and customers to build it, to operate it, to offtake services from that asset. So the resilience of that supply chain is really important to underwrite the credit of that cash flow. Operational risks, we have to remember these are living, breathing assets that are delivering a service every day, and there's quite a range of complexity within our portfolio, from solar assets that are relatively straightforward to complicated waste to energy plants that have multifaceted systems that deliver their service. And then finally, legal regulatory risks. All of our projects operate within a legal regulatory framework, whether that's UK corporation tax or health and safety legislation, environmental legislation. but also where projects are explicitly receiving a subsidy from the government, then we have to think about the prospect of that changing or evolving over the life of projects.
How about performance? Take us through your performance both in terms of NAV and dividends, and also how sustainable your distributions are going forward.
We're celebrating our 15th year from IPO this year, which is a real milestone for us. And over that time, we've delivered a total NAV return of around 183%. So really strong performance. We've paid a stable, sustainable dividend for the last 15 years. That dividend is currently a 7 pence per share dividend target, and that's on a share price of around 78 pence where we are today. So that's around a 9% dividend yield on share price on that dividend that's been paid for the last 15 years. So we think now's a really attractive entry point for the fund. The fact that you can access that income underpinned by contractual cash flows from underlying infrastructure projects at a 9% yield, we think is really attractive. We're very focused on delivering a stable, sustainable dividend. Be in debt, there's not much prospect for capital growth within the portfolio. It's really looking to underpin that income with high levels of capital preservation.
Phil, you had your Capital Markets Day this week. Tell us about the key messages you gave to shareholders and what investors should be watching out for the remainder of the year.
I think the key message we tried to give shareholders yesterday was one of capital allocation and discipline in capital allocation. The whole sector, alternative income sector more broadly across infrastructure, renewables, real estate, is trading at a discount to net asset value. And I think that necessitates a disciplined approach to how we use capital. We, being a debt portfolio, we get a natural repayment of capital through the amortisation of the underlying investments. We've also, for the last couple of years, been accelerating the return of capital through the sale of assets and disposals. And the key question really is how we use that capital that's generated. And what we set out at the Capital Markets Day yesterday was a very clear framework for how we use that capital based on where shares are trading relative to the net asset value. In very broad terms, we set out a mechanism where between a sort of 5% discount to a 15-ish discount, there'll be a return of capital, but also the prospect of new attractive investment opportunities to maintain the scale of the trust and the liquidity of the trust for some of the larger shareholders. But below that 15-ish% discount, then really buying back our shares and returning capital to shareholders has to be seen as the best investment opportunity. Investing in our own risk and the existing risk of the company through buying shares makes most sense at that level.
Phil, what makes Gravis stand out amongst other investment trusts?
I think the key differentiators of GCP are the fact it's a diversified portfolio. We've seen lots of investment trusts focus on a single asset class, and that means they live or die by the evolution of that asset class. And actually over the last 20 years or so, infrastructure as an asset class has evolved fairly materially, and some of the specific asset classes within it have. I remember some of the first conversations we had with investors about solar in the UK, and there were lots of questions around, what do you mean there's sun in the UK, or how are we going to connect to the grid, or how is this going to work from a subsidy perspective? So those risks necessitated a higher return than perhaps where we are today, where through deployment there's scale and those risks have been understood because projects have been built and have been operational for some time. So our ability to get in early to asset classes, capture what we think is an enhanced risk-adjusted return by virtue of being in early, but then when risk dynamics evolve, move into different sectors and take new opportunities, I think has been a key differentiator. I think we've got a great team at Gravis. I think we've invested heavily in our processes and systems. I think as a result of that, the other thing I'd point to in terms of differentiation is our disclosure. We have market leading, I think, disclosure around the underlying investments. That includes an investor portal that we recently published for investors, which I think is the first time in the investment trust space that we've given really granular access for investors to log on and see at a very granular level what the underlying portfolio is made up of.
Well, Phil, I hope you'll keep us updated with your progress. It's been a pleasure having you in the studio.
Thank you for having me.
That's Phil Kent, CEO of Gravis and lead manager of GCP Infrastructure Investments.